Most people only notice silver when the price suddenly moves. They see a chart, they see a headline, they see excitement or disappointment. But almost no one asks the more important question: who actually controls the flow of silver? Because silver is not like stocks, it's not like crypto, and it's not even like gold. Silver is an industrial metal first and a financial metal second. And that single fact changes everything. Over the last several years, analysts noticed something unusual. Large amounts of silver were appearing on the global market, not during a recession, not during a demand collapse, but during periods when demand appeared stable. Prices softened, speculation cooled, yet industrial consumption continued. That contradiction raised questions, not dramatic questions, not conspiracy questions, serious market questions. Where was the silver coming from, and why now? To understand that, we need to start with something basic. China's relationship with silver is very different from how Western investors think about it. China does not treat silver primarily as an investment. China treats silver as an input for manufacturing, an input for infrastructure, an input for technology. China is the world's largest manufacturer of solar panels, one of the largest producers of electronics, a major player in electric vehicle supply chains, and a key supplier of industrial components used around the world. All of these require silver, not symbolically, physically. Silver conducts electricity better than any other metal. It resists corrosion, it performs reliably at scale, and unlike gold, silver is often unrecoverable once it is used. It is spread in tiny amounts across billions of devices. That means industrial silver demand is not optional, it is structural. Now here's where market behavior becomes interesting. When an economy depends heavily on a commodity as an industrial input, it becomes sensitive to price volatility. Rapid price increases are not neutral. They raise production costs, they squeeze margins, they affect competitiveness. For a manufacturing-heavy economy, this matters. So when silver prices rise sharply, large consumers pay attention. They don't need to announce anything. Sometimes they simply adjust flows. In recent years, customs data, trade statistics, and exchange inventories showed periods where silver supply increased on global markets, including silver originating from China or from Chinese-linked supply chains. This does not automatically mean panic selling. It means redistribution. Silver that had been held, processed, or allocated domestically was released outward. When supply increases, prices respond. That is basic market behavior. But here's the key point. This happened while solar installations were increasing, while electrification was accelerating, while industrial demand forecasts remain strong. That matters. Because when prices soften while demand is stable or rising, it usually means one thing: the market is absorbing supply, not rejecting it. And absorption has a limit. You can only release what you already have. Once that silver leaves, it does not come back. That is why the next phase matters more than the first. After those large silver flows, prices stopped falling, not exploding upward, not collapsing downward. They stabilized. Physical premiums in some regions remained elevated. Exchange inventories did not rebuild aggressively. Mining output growth remained constrained. That tells us something. The silver was needed, it was absorbed, and once absorbed, the buffer was thinner. This is not dramatic, it is subtle, but subtle changes are what professionals watch, because silver markets do not break from noise, they tighten quietly. Another important reality needs to be understood. China does not publish transparent data on strategic commodity holdings. This is not unusual. Many countries don't, but it means outsiders must infer behavior from what can be observed. Imports, exports, processing capacity, manufacturing output. When analysts look at these together, a pattern emerges. China's behavior appears consistent with cost management, not abandonment. Managing exposure is rational behavior for a large industrial consumer. It does not require hidden coordination. It requires logistics, and logistics leave footprints. Now let's address a common misunderstanding. Many people assume that releasing supply is always bearish. That is not true. Sometimes supply is released to stabilize conditions, not to signal weakness. Oil markets do this regularly. Strategic reserves are released and replenished, not because oil is dying, but because volatility is dangerous. Silver is no different, but silver has a unique constraint. Mine supply growth is limited. New mines take years to develop, ore grades are declining. Environmental regulations slow expansion. At the same time, industrial demand is not cyclical in the traditional sense. Solar capacity does not disappear. Electrification does not easily reverse. Digital infrastructure continues to grow. This creates long-term tightening, not instantly, gradually, which brings us to the present moment. After periods of noticeable silver outflows, those flows eased. Markets no longer saw the same level of supply entering. This does not mean a dramatic reversal. It means redistribution largely finished. And once redistribution ends, the market must rely on ongoing supply alone. That is where tension builds, because ongoing supply is not growing quickly and ongoing demand is not shrinking. This does not guarantee price spikes, but it removes complacency. It limits downside comfort and it increases volatility potential. Silver begins to behave less like a forgotten metal and more like a strategic material. China's role should not be exaggerated, but it should not be ignored. China is not acting alone. Other nations face similar pressures, but China's scale makes its actions visible, and when a large participant adjusts behavior, markets notice, eventually. What matters most is not intent. Intent is unknowable. What matters is impact, and the impact is observable. Silver inventories are tighter, industrial demand remains strong, supply growth is constrained. That combination is not explosive, but it is unstable. And unstable systems do not need triggers, they need time. This is why silver keeps returning to discussions about strategic materials, not because of hype, but because of necessity. Historically, silver has always played this role during periods of transition, not because it is special, but because it is required. The lesson is simple. Markets adjust before people understand why. By the time explanations become popular, the adjustment is already underway. This is why serious participants watch flows, not headlines. Flows reveal priorities. Priorities reveal pressure points. And silver is a pressure point, not collapsing, not exploding, but tightening, quietly. If you've stayed to this point, you already understand something most people don't. Markets do not warn you loudly, they whisper, and silver has been whispering for a long time. If this video helped you see silver more clearly, subscribe. This channel focuses on how markets actually work, not how they're marketed. And comment below. Do you think silver is still misunderstood? Or do you think its industrial role will force a revaluation over time? Because the most important shifts rarely announce themselves, they only look obvious after they've already happened.